Let's review chapters 10, 11, 13, 14, and 15. So this first question says, Linton Company purchased a new machine on October 1st, 2019 at a cost of $150,000. The company estimated that the machine will have a salvage value of $12,000. The machine is expected to be used for 10,000 working hours during its 5-year life. During 2019, there were 400 hours of usage. So we need to compute the depreciation expense under each of the following methods for 2019. So we will use straight line, units of activity, and the declining balance method. Let's start off with straight line. So I have all of the important information up along the top, and then the equation for the annual depreciation expense. So we're going to take our cost minus our salvage, divide it by the number of years in its expected life. So we fill in those numbers. $150,000 minus $12,000 divided by 5, and we find an annual depreciation expense of $27,600. But we aren't done here. We purchased this October 1st. So we didn't have it for all of 2019. So we need to multiply our annual depreciation expense, the amount of depreciation for the entire year, multiply that by 3 over 12. Because we had it for 3 months. We had it for October, November, and December. So 2019's depreciation under the straight line method is $6,900. Now for units of activity. Our formula is a little bit different here, right? We're going to take cost minus salvage, divide it by its life in units, and just that will give us what's called the depreciable cost per unit. Then we multiply that by the usage, right? How many units did we use this for? Here, our units are hours. So we're going to look to see how many hours did we use this equipment for. So we plug in the numbers that we know. We know our cost and we know our salvage value. Those are still the same here in the units of activity method. Our life in units, well, we expect this machine to be used for 10,000 hours during its life. So 150,000 minus 12,000 divided by 10,000, that is your depreciable cost per unit. Then you multiply that by how many hours you used it for. Told us that we used this machine for 400 hours in 2019. So we take $13.80 times that 400, and we find a depreciation expense of $5,520. Now declining balance. Our annual depreciation expense will be the book value times 2 over the number of years in its life. So you might have heard this as book value times double the straight line rate. Well, the straight line rate is just 1 over the number of years in its life. So to double that, we put 2 over the number of years in its life. Now book value. How do we find book value? Well, book value will be your cost minus your accumulated depreciation. Here, we just purchased this equipment, so we haven't depreciated anything yet. So our book value is $150,000 minus 0, because we don't have any accumulated depreciation, times 2 over 5. That comes out as an annual depreciation expense of $60,000. Now, just like we talked about with the straight line method, we haven't had this machine for an entire year. We just purchased it October 1st. So we need to multiply that 60,000 times 3 over 12 again. And our depreciation expense for 2019 is $15,000. Now question number 2 says Beth Corbin's regular hourly wage is $16 and she receives an hourly rate of $24 for work in excess of 40 hours. So she gets time and a half for overtime. During a January pay period, Beth worked 45 hours. Her federal income tax withholding is $95. She has no voluntary deductions, and the FICA tax rate is 7.65%. So we need to figure out her gross earnings and her net pay, and then prepare the journal entries to record her pay for the period and the payment of the wages. So let's first work on finding gross earnings. So gross earnings is the total amount that Beth Corbin earned. So she worked a total of 45 hours. So let's split that up between the regular 40-hour work week and then the 5 hours of overtime. Her normal pay per hour is $16. So that's the amount that she gets paid for those first 40 hours in the week. For overtime, she gets paid $24 an hour. So if we take our number of hours times our hourly wage, we can figure out that in those 40 hours, she earned $640, and then in her 5 hours of overtime, she earned $120. So how do we figure out the gross earnings? Well, the gross earnings, again, is just the total amount that she earned. So we add up that $640 and $120 to find out that our gross earnings are $760. Now, that's not the amount that she's actually going to be getting paid, right? Because the amount that she gets paid is her net pay. So we need to figure out her net pay. That's going to be the gross earnings minus the deductions. So we were told in the problem that her federal income tax withholding is $95. So we'll write that down as our deduction. No voluntary deductions, and then the FICA tax rate of 7.65%. So we need to figure out the FICA amount for Beth Corbin. So we're going to take the gross earnings and multiply it by 7.65% or 0.0765, and the amount in FICA taxes that will be deducted from this paycheck is $58.14. Right? So FICA taxes, your Social Security, and your Medicare, Beth Corbin has $58 deducted from her paycheck for those. So now we need to figure out the total deductions. So we add up our federal income tax and our FICA to find that the total deductions will be $153.14. Now, to find net pay, again, it's your gross earnings minus your deductions. Well, our gross earnings were $760. Our deductions were $153.14. So the net pay is $606.86. So that's the amount that will be on Beth Corbin's paycheck. Right? She's going to get a paycheck for $606. So now we can start talking about these journal entries. Journal entry for her pay for the period. It's going to look something like this. Right? We need to debit our salaries expense. And then we credit our deductions. We have federal income tax payable, FICA tax payable, and then we credit salaries and wages payable. Now, how do we figure out the numbers here? Well, we already know our federal income tax and our FICA tax. Right? That's $95 and $58.14. Now, the other numbers that we have found have been our gross earnings and our net pay. So, Remember, your net pay goes under payable. Your gross earnings goes under expense. So we'll put the 606.86 under our payable, and our expense is our gross earnings, because our debits and credits have to equal, right? So if we flipped those two, our debits and credits wouldn't equal. Now, the payment of Beth's wages. So this is when the company is writing out that paycheck. We need to debit our payable, and we're going to pay Beth cash, so we'll credit cash. Where do we get this number from? From the previous entry. Right? We take that out of our payable account now by debiting payable $606. And then we show that our cash is decreasing because we're paying our employee. So question number 3. Ortiz Corporation issued 2,000 shares of common stock. We need to prepare the journal entries for the issuance of that stock under the following assumptions. So we had a par value of $5 per share, no par or stated value, and then a par value of $5, and it was issued for land. So let's first work on saying that the stock had a par value of $5 per share and was issued for a total of $52,000. So we are getting cash, right? The company is issuing stock to get money. So we'll debit our cash. And how are we getting this cash? We're getting it because we issued stock. So we'll credit our common stock. We will also be crediting paid in capital in excess of par, common. Now, how do we figure out the numbers here? Well, we were told that we issued this stock for $52,000. So that's how much we want to debit cash for. Common stock? Well, we're going to need to calculate this one. We're going to take the number of shares that we issued, multiply it by our par value. So 2,000 shares times that $5 par value, and we find that our common stock is 10,000. So we'll credit common stock 10,000. Now, paid in capital in excess of par, we need our debits and credits to equal. So that becomes 42,000. Now the next part, the stock had no par or stated value and was issued for a total of $52,000. Once again, we're getting cash. And why are we getting this cash? Because we issued stock. So we debit our cash and we credit common stock. Now, in the last example that we did, we credited an account called paid in capital in excess of par. We can't be in excess of par if we don't have a par value. So we don't even worry about that account. So we say that we got $52,000 in cash, and our common stock is also worth that $52,000. Now this last one, the stock had a par value of $5 per share, so we have a par value again, and it was issued for land worth $52,000. So here, instead of getting cash from an investor, we got land. So land is an asset. We want to debit our land to make that account increase. And how did we get this land? Why did anyone give us land? Because we issued stock. Right, so we'll credit common stock. Now, we had a par value again, so we're also going to be having paid in capital in excess of par. How much is this land worth? $52,000. So we want to debit our land for $52,000. Common stock, we have to calculate it again. right? We take our number of shares times the par value. So 2,000 shares times $5 a piece gives us that 10,000 again. And we need our debits and credits to equal now. So we'll credit our paid-in capital in excess of par, 42,000. Now, question number 4. Reinhardt Corporation purchased from its stockholders 5,000 shares of its own previously issued stock for $255,000. It later resold 2,000 shares for $54 per share, then sold 2,000 more shares for $49 per share, and then finally sold the last 1,000 shares for $43 per share. So we need to prepare the journal entries for the purchase of the treasury stock and then the 3 sales of treasury stock. So first, Reinhardt Corporation purchased from its stockholders 5,000 shares of its own previously issued stock for $255,000. Well, whenever a company buys back their own stock, we call that treasury stock. So we'll debit our treasury stock here. And how did we buy this stock? Well, we used cash. So we will credit our cash for the $255,000. So that's the purchase of treasury stock. Now we have those 3 different sales, right? The first one, we sold 2,000 shares for $54 per share. So we're getting cash, right? We're selling this stock, so we are getting cash. We're selling our treasury stock, so we need to decrease our treasury stock account with this credit. So now let's start figuring out some numbers here. Cash. We're going to take the number of shares that we sold times the price per share that we sold it for. So 2,000 shares for $54 per share is $108,000. So we'll debit our cash $108,000. Now, treasury stock. We are going to need to figure out the price that we paid when we first purchased this treasury stock. So we take the total amount that we paid, that $255,000, divide it by the number of shares that we purchased, the 5,000, and we see that we paid $51 per share. So that's going to be true for all 5,000 of these shares that we have. We paid $51 per share. So to find our treasury stock number in this entry, we take that $51 per share, multiply it by the 2,000, because we are selling 2,000 shares. So our treasury stock will be credited $102,000. Now, you'll notice your debits and credits don't equal, right? That's why there was a gap between cash and treasury stock in this entry, because we now need to credit paid-in capital from treasury stock. And how much? Just that $6,000. Right, the difference between your cash and your treasury stock. So, when you're working through treasury stock entries, you'll always want to keep a T account for your paid-in capital from treasury stock. And you'll see why later on in this problem. So, we'll make a T account and we will put this credit of $6,000 into that T account. So, we make another sale. We resold 2,000 more shares for $49 per share. Our entry is going to look pretty similar here. We still got cash, right? We still sold this treasury stock and received cash. So we will debit our cash, and since we sold our stock, we're going to credit our treasury stock. So if we work through and figure out these numbers, for cash, we sold 2,000 shares at $49 per share. So we received $98,000 in cash. So that's our debited amount for cash. Now treasury stock. Remember, we calculated that it was $51 per share. Here, we're selling 2,000 shares. So we need to credit our treasury stock $102,000. Now, we need to make our debits and credits equal again. But this time we need to add more on the debit side. So, we'll debit paid in capital from treasury stock. And we need 4,000 more on the debit side, right? So we take a look over at that T account. Your paid in capital from treasury stock can only have a credit balance or a zero balance. So we can debit up to 6,000 right now and still be okay. The good news, we only need to debit 4,000 to make our debits and credits equal in this problem. So we are still left with 2,000 in our paid in capital from treasury stock account. Now, our last problem here. We sold 1,000 shares for $43 per share. We still received cash and we still sold treasury stock. So we will debit our cash and credit treasury stock. The cash amount, that's going to be our 1,000 shares times the $43 per share. So we'll debit cash $43,000. For treasury stock, we originally found that it was $51 per share. Here, we're selling 1,000 shares, so we need to credit treasury stock $51,000. So, our debits and credits don't equal again. In a perfect world, we would just debit paid in capital from treasury stock $8,000, right? And that would make our debits and credits equal. But we only have $2,000 in that account. So, we can only debit paid in capital from treasury stock $2,000. And that's it. And then it doesn't have anything left in that account. But we still have this $6,000 that still needs to be put over on the debit side. That gets taken out of your retained earnings. So your retained earnings is going to be used for treasury stock transactions, dividends. It's money that your company has kept over the years from net income, right? So it's just money that will be used in transactions as needed. So here, since we sold our treasury stock at such a loss, we need to take money out of our retained earnings. So now question number 5. On January 1st, Frontier Corporation had $1 million of common stock outstanding that was issued at par. It also had retained earnings of $750,000. The company issued 40,000 shares of common stock at par on July 1st and earned a net income of $400,000. We need to journalize the declaration of a 15% stock dividend on December 10th, the par value being $10 and the market price is $18. Then, on December 31st, we need to journalize the issuance of the dividend. So we have the declaration of a stock dividend and the issuance of a stock dividend. We need to prepare these journal entries. Before we can move on to these entries, we need to figure out a few pieces here. The first thing, we need to figure out how many shares did we have initially on January 1st. So, we were told that our common stock was worth $1 million and that it was issued at par. So we can find our number of shares by taking 1 million divided by 10. So on January 1st, we had 100,000 shares of stock. But we are declaring the stock dividend in December. So just because we had 100,000 shares in January doesn't mean that we still only have 100,000 come December, right? So the problem tells us that we also issued 40,000 more shares in July. So our number of shares after July would be 100,000 plus that 40,000 that we issued. So now we're sitting at 140,000 shares. So now we can start thinking more about this stock dividend, this 15% stock dividend. So we can figure out how many shares are we handing out, right? How many shares are in this dividend? Well, we had 140,000, and this is a 15% stock dividend. So we take 140,000 times 15%. So this dividend is 21,000 shares. So we'll use that number when we're working through this journal entry. So when you declare a stock dividend, you will debit the account stock dividends. You'll credit common stock dividends distributable and paid in capital in excess of par. Now for the amounts. Well, for your stock dividends, this is going to be your number of shares in the dividend multiplied by your market price. So our market price is $18. 21,000 shares times 18 gives us 378,000. So we'll debit our stock dividends 378,000. Now common stock dividends distributable. This is how many shares times your par value. So 21,000 shares times our $10 par value gives us 210,000. Now, paid in capital in excess of par. Few different ways that we could figure this number out. First, our debits and credits have to equal, right? So we could just take 378 minus 210. But there's another way to do this. We take our number of shares times the difference between market price and par value, right? This is an account showing how far above par value are you. Well, we're $8 above par value here. So 21,000 times 8 will give you 168,000. Now, journalize the issuance of the dividend on December 31st. So now we are handing out these shares to our shareholders. We need to debit our common stock dividends distributable. Because they're no longer distributable, they're now being distributed, right? So we'll decrease that distributable account. And then what are we handing out to people? Common stock, right? We are handing out stock. So we'll credit our common stock. And where do we get these numbers from? It's the 210,000 that we had in our declaration journal entry. Now question number 6. Robles Corporation was organized on January 1st, 2016. During its first year, the corporation issued 2,000 shares of $50 par value preferred stock and 100,000 shares of $10 par value common stock. At December 31st, the company declared the following cash dividends. So December 31st, 2016, they declared $5,000 in cash dividends. December 31st, 2017 was $12,000, and December 31st of 2018 was $28,000 of dividends. we need to show the allocation of dividends to each class of stock. So how much goes to preferred and how much goes to common, assuming that the preferred stock dividend is 7% and cumulative. So, before we can start breaking up those cash dividend amounts between preferred and common, we need to first figure out how much is preferred supposed to get. So, the annual preferred dividend is your number of preferred shares, so that's our 2,000 shares, times the par value, our $50 par value, times our dividend percentage. That's our 7%. So we plug those numbers in, and we find that our annual preferred dividend is $7,000. So every single year, we're supposed to give our preferred stockholders $7,000 in total. So we'll remember that as we're dividing up these cash dividend amounts. So we set up a table like this, figuring out how much goes to preferred and how much goes to common in each year. So let's just look at 2016 right now. In 2016, we're a new company and we can only give our shareholders a total of $5,000. It's a bit of a problem, right? Because we told our preferred shareholders that they would get $7,000 every year. Well, what is going to happen here is preferred gets the first $7,000 every year. So we can't just magically give them an extra $2,000 to make them happy, right? So they get all $5,000 of this dividend, leaving nothing left over for common. Since our preferred stock dividend is cumulative, we also owe our preferred shareholders that extra $2,000 that they didn't get in 2016. If our stock dividend was non-cumulative, they would just totally miss out on that $2,000. So now we can move on to 2017. 2017, we did better as a company. We could give out $12,000 of dividends. So now we're looking at preferred. Preferred is supposed to get $7,000 every year. Can they get that $7,000? Yes, because we're giving out a total of $12,000. But they could also get that extra $2,000 that we owed them from the year before. So preferred is going to get a total of $9,000 in 2017. They get their normal $7,000 dividend plus the $2,000 that we owed them from the previous year. So we are handing out a total of $12,000. $9,000 is going to preferred. That leaves $3,000 left for common. Now we move on to 2018. In 2018, we've had a much better year, and we're handing out $28,000 in cash dividends. So, preferred shareholders, they're supposed to get $7,000 every year. We don't owe them anything from previous years anymore, so they will just get their $7,000. So if we are giving preferred $7,000, that means that there's $21,000 of dividends left over for common. So this is how you would allocate your cash dividends between preferred and common for each year. So remember, you find your annual preferred dividend first. You take your number of shares times the par value times your dividend percentage. That's how we got that $7,000. Then we break it up year by year. Now our last problem here says Price Company issues $2 million 10-year 8% bonds at 97 with interest payable each January 1st. So Price Company's issuing these bonds, right? So let's break down what it says up in that problem before we look at parts A and B. $2 million. That's the face value of these bonds. 10-year, that's the term. That's going to be when you have to pay back these bonds. So you're going to have to pay it back in 10 years. 8%, that's your interest rate. Then at 97, that means that when we issued these bonds, we only got 97% of face value. So we'll remember that now as we prepare the journal entry to record the sale of these bonds on January 1st, 2019. And then, assuming instead that the bonds were issued at 104 or at 104% of face value, we need to prepare the journal entries to record the sale of the bonds. So this first one, issuing bonds at 97, right? So we're issuing at a discount. We're still getting cash though, right? Companies issue bonds to get an influx of cash. So we will be debiting our cash. We'll be crediting bonds payable. Bonds payable is always going to be the face value of your bond. So we said our face value was $2 million. So we'll credit bonds payable for $2 million. Our cash amount we're going to need to calculate. Since we issued these bonds at 97, again that's 97% of face value. So we take our face value, our $2 million, multiply it by 0.97, our 97%, and we see that we got $1,940,000 in cash. So our debits and credits don't equal here. Why not? Well, we need this extra 60 over on the debit side, and that's going to be the discount on bonds payable, because we are issuing these bonds at a discount. Now, instead of issuing them at 97, we were able to issue them at 104. So that's 104% of face value. So here we're issuing our bonds at a premium instead of issuing them at a discount. But we're still getting cash. So we still need to debit our cash. And why are we getting cash? Because we're issuing bonds. So we debit our cash and credit bonds payable. Bonds payable, once again, is the face value of your bonds. That's the $2 million. Cash, we'll take our $2 million times 1.04, the 104%, and we end up with a cash amount of $2,080,000. So we'll debit our cash for that amount. So we still need to credit an additional $80,000. And since we are issuing these bonds at a premium, we will credit premium on bonds payable.